Perfect.
And here come some amazing people. Thank you all so much for being here with us. We're so excited to talk about early stage investments with you. And we'll get started in just a minute here. We want to be respectful of your time. So we'll end right at the top of the hour. We already have, I think, 10 or so questions queued up, but we'll look forward to answering more. So feel free to drop some in the chat, but I'm going to go ahead and jump into questions. Maybe quick intros first, though.
Yeah, well, welcome everyone. I'll go first, and actually, everyone, if you want to, I don't know if the chat's enabled, but if you want to say where you're coming from, that's always fun to see where you all are from, and maybe if you're a founder or an investor, that would be helpful as well. But I'm Elizabeth Yin, even though it looks like I'm Haley Bryant on the Zoom. We're having some technical difficulties. I've always wanted to be like Haley, so hopefully this will help. But I am Elizabeth Yin, and I'm one of the co-founders of Hustle Fund. We are a pre-seed venture capital fund. So we invest at the earliest stages, like 2 people in a garage type of stage. And we invest globally. And prior to that, I was an entrepreneur. So throughout my journey, I think between being an entrepreneur, after I exited till now, I've invested in over 700 companies.
Wow. And I'm here because I want to be like Elizabeth, actually. I'm Haley. I'm a principal at Hustle Fund. I've been with the fund for the last 3 months in this role, and with the team more broadly for just over a year, working with our angel investor community, Angel Squad. Before Hustle Fund, I was an operator. I ran a B2B SaaS content marketing agency. Would love to talk about go-to-market with any and all of you. And before that, worked for a couple of different startups and also ran Apple retail stores. So diversity of experience. I've done just about 50 angel investments and about 10 investments through the fund. So nowhere near the volume that Elizabeth has looked at. So I'm also excited to learn from and with her and all of you today. What I'll do is go ahead and kick us off with a couple of the questions we got before the call. We'll talk through them. Would love follow-up questions from you, and are looking forward to more questions you have in the chat. So the first question came in, I think, from Kara, actually, and that was around Prorata Rights. What are they, and how to convince a founder to give them to you if you're an investor?
So I had no idea what this was when I was a founder. An investor asked me when I was pitching them way back then, like, oh, so can I get Prorata Rights? And I was like, sure. So Prorata Rights. Well, I guess conceptually what happens when you raise money? You raise money, and then maybe you raise money again as a founder. And then that next time that you raise money, actually the first set of investors typically get diluted down. So meaning like they may have, say, bought 10% of your company. Now, after the second round, because more shares are issued, they no longer have 10% of the company. They have something less, maybe like 8% or whatever. So over time, as you can imagine, those very first investors get diluted down quite a bit, and they can be diluted down even as much as more than 50% if the company continues to do well and raise more. So what that means then is these early stage investors are like, well, I actually would really like to have high levels of ownership here, and I just keep getting diluted down. Can I invest more to kind of maintain my stake? So Prorata is the amount that you need to invest at every round to maintain the stake that you started with. So if you, say, bought 10% of the company, you then put in the next round a certain amount to retain 10%. So going back to the question then, should you participate in Prorata? Is that the question?
Yeah, so I think this came from an investor's perspective, how to convince a founder to give you Prorata. And then I guess from the founder side, does it make sense to give investors Prorata?
Yeah. So a lot of investors will typically ask founders, hey, can I get Prorata rights when they invest at this very moment? And so it's like thinking down the road. And it's a very common ask. And I think, you know, with both my founder and investor hat on, it's a good way to kind of, I don't know, appreciate your early backers. And obviously I am biased as an early backer, but I always like it when founders do give that to their early backers. I mean, I think even if it is not structured formally, it is always good to ask your early backers like whether they want to continue participating, and they would love that opportunity. As an investor, should you participate? I think the answer depends a lot on your model. I think that a lot of investors actually blindly say, yes, let's continue, you know, trying to maintain our stake because I don't want to get diluted down. But actually, at the end of the day, investing, all it's about is like, you have a limited amount of capital. What is the best use of that capital? And so it could be to take that capital and put it in your pro rata on a particular company, or it could be maybe you're making 2 new investments, or for an angel investor who can literally do whatever they want with their money, it could even be to buy a new roof on your house. So what is the best use of that limited capital? And I don't think the answer is always to participate in your pro rata. Certainly if the company is very fast growth, then probably that is a good decision. But if it's, you're not really sure where this company is going and you have these other 2 exciting companies you want to make new investments in, then maybe that's actually the better option.
Yep, that makes sense. And I see how pro rata is beneficial for the investor, and it's a great way to reward those early believers, giving them the opportunity, the optionality to continue to invest in following rounds. But I guess I'm curious about the downsides for a founder. I don't think it's necessarily true in this market, but one of the things I experienced as an angel last year was founders pushing back a bit on pro rata because maybe they had eyes towards securing a really strategic lead based on sector expertise or brand in a following round. So they wanted to make sure they had space. I have not seen that happen this year in having negotiations, but that was one of the reasons I did see a hold up or have in past.
Yeah, and this is a great point, Haley. I mean, I think from the founder's perspective, obviously you have a limited amount of space. So you have 100% of the company and how it gets allocated, right? So if you're letting people maintain, let's say their 10% stake, well, you can't let everybody do that. So something's got to give. And so that's the flip side as a founder. I would say the dirty secret for everybody in this room, whether you're an investor or founder, is at the end of the day, the pro rata rights do not matter at all, because even if you sign it as a founder, or even if you sign it as an investor, or whatever, like even if you agree upon this or not agree upon it, everything can change in the next round anyway. Like your next round of investors could include language in their deal agreement saying, hey, all pro rata rights from before are out the door. So this is why at the end of the day, actually, you can put as much as you want in the legalese, but it really is the relationship between the founder and the investor that matters. If you have a strong relationship, then, you will find a way to work together more.
Yes, love that. Here's another question. This one's from Andrew, who's a member of Angel Squad. What's a good way to tell a founder you aren't interested in investing in their company at this time?
Oh, so many ways. I think for an angel, it's a lot easier, right? Because an angel, you don't have a fund. It's your personal money. You can do whatever you want with it. You can say, well, unfortunately, like my finances are a bit tight right now, or, I pulled back from investing, or I'm just so busy with my day job. I just don't have time to look at anything new. Plenty of excuses, and they could be legit excuses. As a fund, you don't have that luxury because you have a fund that is dedicated to investing, so you have to invest. So I think the excuses are, well, there's real reasons and then there's fake reasons. So fake reasons everybody gets is like, oh, it's not a fit or whatever, something generic. I've gotten a lot of those. If you want to do right by the founder and actually help them and give them a bit of a tidbit, like I would actually be direct. And we very much err on the side of being direct, like kind, but direct. Cause I think having been a founder before, I've always appreciated those more direct responses. Like, these are the, like, really like you. So positive things about the business. Hopefully you can find something positive and it's not all doom and gloom. And then what are the things that you can't get over? Like if those things were to change, you'd be in. And it could be crazy. It could be like, I think this, the sales cycle, I personally think the sales cycle is going to be, too long per the capital that we can put in. So unfortunately, I don't have conviction on that. And you could be completely wrong, but that's your opinion. And I think it is a service to founders to offer that opinion if you have that confidence and strength.
Yeah, one of the things I've learned from you is to be kind, direct, and quick, and share actionable feedback if possible. I think you've shared back in the early days of the fund, you, Sheehan, and Eric try to get back to people in like 48 hours or something. So thinking about these founders taking 200 meetings in some cases to raise a seed, and then getting that fast feedback probably mattered a lot in building that relationship for maybe the next company that you do want to invest in. And the actionable feedback piece is interesting. I think you've actually given me feedback on emails before where it made sense to maybe remove something or to caveat my feedback a little bit, like, this is my opinion, just my 2 cents, versus saying, just take this feedback as it is. And it is very important to know what feedback to take as a founder.
Haley, you're so good at delivering that. I mean, I think that's the key thing to emphasize, which is like, this is my opinion, and I could be completely wrong here. And actually, I have sent some of those emails, and some of those companies went on to do really well. So I am wrong a lot. And that's the thing about being an investor. Actually, you can still do really well and be wrong like more than half the time, which is crazy. You would never want that in your brain surgeon, to be wrong half the time, but it's not bad as an investor.
That's a pretty good track record. Yeah, I would definitely go for that. Here's a question from someone who's on the call right now. Darren, thank you. What attributes in founders have you found to be most correlated with eventual investment returns?
Oof. Well, I'm 7 years into this journey. So that's actually not that long compared to what it takes to build a big startup, as you all know. Like Dropbox IPO'd in 15 years. So there's some caveats there. But I mean, I think what I have noticed is these up and down markets happen like within every decade. So everybody's got an up part of their journey and a down part of their journey that you have to navigate as a founder. And the problem is nobody knows when the ups are coming and when the downs are coming. So I have found, especially now in this down, the founders who are frugal and scrappy and have a lot of, just focus on putting their resources towards one thing tend to do really well. The flip side is like people who are super spendy or don't make the cuts that they need to make, or kind of are not scrappy and creative and thinking about how to pay for things, like that tends to be okay in an up market if you get lucky, but in a down market, that is just tough.
Yeah, that makes a ton of sense. And one of the things that drew me to Hustle Fund was the interest in working with founders who are customer obsessed, who really try to understand who their customer is, can speak at length about the ideal customer profile, what the pain is, what problem they're solving, how they're solving it, how they'll acquire them, how they'll retain them. I think that piece can be overlooked, but that's really what set a lot of founders apart for me.
So important. Yeah.
Here's a question from Dan, also an Angel Squad member. Great to see you, Dan. Hi, Elizabeth. Could you comment on the impact of hype cycles on investment decisions? For instance, with the release of ChatGPT, AI is now being much hyped. Do you gravitate towards hype sectors, or does it warrant caution and a more reserved approach?
I'll answer that in a couple of ways. So one, I think one of the things that, and this actually ties with the last question, what's important? I think the other thing regarding the idea, so not founder specific, but the idea is that I think it's really important to be differentiated, and not just differentiated from direct competition, but all other alternatives out there. So it could even be differentiated from pen and paper. How much better is this than pen and paper? So, and I think that's often overlooked. And the reason why it's important is I've found that when I've invested in companies in crowded spaces, even if they were great founders, it's just really hard because, number one, your cost of customer acquisition is high because you're competing with all these other people, right? So your acquisition costs are high because you have to combat all the potential alternatives. Even if you take a seemingly free sales channel like outbound email, you're still competing against all the noise of everyone else who's sending the cold emails. So you're competing on attention. So there's a big cost there that a greenfield market does not have. So that was one learning that I have, like differentiation is really important. So tying that to this answer then, the thing about it is I tend to look for greenfield ideas as a result of that, because we're a small fund, we're putting in small dollars. We can't be in a customer acquisition war, like a CAC war. So what we need to happen is we need the idea to basically be able to get to customers relatively inexpensively. And what does that mean? It tends to mean areas that are new, or geographies that are new, or demographics that are overlooked, or whatever that is. In the case of hype cycles, there is something to it where if you are early in the hype cycle, the CAC is really low. If you get to the hype cycle maybe 2 years too late, so I'll give you an example. One hype cycle right now is call it GPT-3 for writing. There are a boatload of these. We've got a couple of investments in this that we made a couple of years ago. it happened. It was the right timing. Both of those companies are doing super well. A lot of the companies that were sort of in that first wave are doing really well. If you're coming in now or a year from now with a GPT-3 writing idea, it's too late because you'll have to compete with that high level of CAC that these larger incumbents can afford to pay versus your small startup. And so if you're entering the hype cycle, it's really important that you are coming in super early to catch that wave. Because if you are just a bit too late, then you're fighting CAC. That's my perspective.
Yeah.
Haley, do you have any thoughts?
No, I think that makes a ton of sense. I do review a lot of the cold inbound we get at the fund. So I'm able to see if I look at, maybe once a week, 100 deals where there are a lot of competitive deals and try to stay away from those just because, to Elizabeth's point, I know it's going to be fairly competitive in terms of customer acquisition. I don't know what strategy is going to win. We don't talk to the founders enough to really understand this team is significantly better than that team. Where I've had, I don't want to say challenges, but been thinking more about is the opposite of the hype cycle, like thinking about investing in Web3 right now, for example, like where there's maybe opportunity there because we're in a bear market and there are a lot of naysayers. So I think that that's kind of an interesting space to be looking at, although I don't have any strong theses there.
And again, I think it comes back to CAC because like in a down cycle, like actually I am very excited about Web3 now because everyone is leaving except for the people who are really serious about it. Well, actually that creates greenfield because everyone is leaving, right? So I like that. Basically, I'm looking for greenfield where CAC is low at this point in time. So in a hype cycle, unfortunately, it means that CAC goes up very quickly. And so you have to really kind of catch it at the right time.
Yes, totally. I have seen a couple of examples where people have a really unique go-to-market. They have some sort of advantage because of the network they already have, which only gets you so far. But if it helps you move really quickly and is fairly efficient, maybe it's a B2B go-to-market versus B2C in like fintech, for example. I can see that working, but it's hard to choose in the more competitive markets for sure. And I ask Elizabeth about it regularly. Here's another question from someone who's on the call. Is it Ashi? Thank you for asking. Have you found any generative AI ML tools that are helpful for founders to quickly understand investment terms? Interesting. Caveat is, of course, that a generative AI or ML tool cannot replace a lawyer.
There are some that are starting, and actually I have not dug into this. There's a company called I don't know if they go by Tome or To Me, but they are a legal tech startup that kind of compares safes and stuff. I don't know if they summarize like deal terms, but yeah, that one. Thanks, Vlad. I haven't dug into that, but I would look into that. I think the other thing just outside of AI is on the Y Combinator website, there's a very comprehensive like tutorial on how their safe works. So they even go through a couple of examples.
Yep. And what you could potentially do with ChatGPT, and I haven't tried this, but maybe check it out, is ask for them to explain terms like year 5, for example, in really simple language. That might be helpful.
I love that. I need to try that myself.
I've been playing around with it a little bit. Have you been playing around with the different AI tools with your kids too?
Yeah, well, they really like Dolly because you can create all kinds of pictures. My older one has framed pictures like all over the walls.
Oh, that's awesome.
Dolly created pictures. So
it's going to be a fun holiday break. That's awesome. Thank you for that question, Ashi. And then Tori asked, what advice do you have for social impact startups when we talk about impact and investment return? How interested do you think VCs are in impact?
So VCs are incentivized completely by return on investment, ROI. So the impact part actually does not matter to them at all. What you're trying to sell traditional VCs is that this is the highest returning thing that they can do with their money, as opposed to any other startup out there or any other opportunity out there. Now, this is where I know there are a bunch of angels on the call, and there are family offices that are basically richer angels. And angels and family offices can do whatever they want with their money, and many of them want to do good in the world. And for them, the end goal is not necessarily to make the most amount of money. So depending on your startup, it could be that your startup actually will make a boatload of money. Don't sell it based on social impact, sell it on ROI for VCs. But if you're approaching any of these family offices or angels who are like, yes, I want to have an impact on climate change or whatever it is, like make sure that you emphasize that with that audience. So you may actually end up having two pitches depending on who you're going to.
And I think to the point on returns, where VCs are less likely to invest is where they see there's a lot of competition. For example, I've seen a lot of tools that measure the impact of ESG efforts. So I think that that's harder to invest in, but if you can find a different angle that where there is green space and there can be really strong returns and position it as such, to Elizabeth's point, you can do really well. I met with a VC last week in New York who is very focused on companies that are making a huge social impact. And I was like, that's so great. I love that you lead with mission. And he's like, well, no, it's about returns. Like this is where there's a ton of opportunity because people are ignoring some of these spaces. So it's good to kind of balance both.
And this is probably a good place in the conversation to emphasize that actually VCs and angels are very different. I know they both seem similar, and I thought they were the same when I was an entrepreneur, frankly speaking, because they both deploy money and often into startups. But I think people have to understand that as a VC, you are managing other people's money. So actually, you know, what you can do is not anything under the moon. It's whatever mandate you set out with your investors, and you can't deviate from that. So if you set out with your investors, hey, we're going to invest in software and make the most money possible, that's what you're doing. With an angel, they can literally do whatever they want with the money. It could be invest in startups. It could be like go on some fancy vacation. It could be anything. So there are pros and cons to both, but you should understand when you're pitching as a founder, your pitch may end up be different because you need to find out what motivates that particular investor and where their money is coming from.
And this might be a good segue into another question that we received before the call. When would you advise a founder to look for funding? And I'm thinking about this in terms of both when and then what type of funding to look for when.
Yeah. So in general, my thought, having gone through the fundraising gauntlet many times, is I would try to fundraise when it's easiest. It's never easy, but there are times when it's easier and there are times when it's harder. I personally think that it is really, really hard at the stage where you don't have anything. Like if you're trying to pitch an idea, you have no customers, you have no revenue, that's really, really hard. Personally, I think if you want to set yourself up for the best possible raise in the earliest stages, like I would not quit your job. I would try to vet out your idea, like on the side, nights and weekends, like call up potential customers, etc. Try to even pre-sell ahead of building the product. So you validate for yourself that it's worth quitting your job. And then once you get some level of validation, then maybe start building and have something to show. An ideal scenario at pre-seed is you have something to show and maybe you have some validation around customers. Ideally revenue, ideally contracts, ideally, you know, something in writing, like something. That's probably the best time at pre-seed. But obviously the more you can push that out, like if you can even get to seed, get traction up a lot higher, that's even more ideal. Like the more you can validate yourself and do on your own, the easier it is to raise. There's always this balance of like spending your time raising versus spending your time on the business.
Yes. And that actually relates to another question that Tal from Stack had around how long before you start raising should you start building relationships with VCs and how? And then I'm curious if like you think this is a good use of time versus focusing on building out that MVP and trying to validate that you're solving a problem for your customers.
I started my company in late 2008. And I wasted a lot of time trying to build relationships with investors. None of them came in. And by a lot of time, I mean, I did that a lot in the first, call it 6 months. And that was a waste of time. And I realized that. And then I continued to do that off and on for the next 2 years, basically. And that didn't really go anywhere. I didn't get my first, 100K until 2011. So what should I have been doing? I should have been actually not wasting all that time with all those investors. I probably wouldn't have even built those relationships, to be honest. I probably should have just started validating, getting some money in the door, probably not quit my job so early because it does take a while. And then once I had something, then tested the waters to see if there's interest. There was no interest. I was too optimistic. and then just focus more on revenue from customers. Honestly, I think it could be easier in this market to get revenue, and not even necessarily through your product. Like you can throw events, you know, you can do some consulting. Like there's nothing wrong with doing that. And sometimes those activities actually not only bring in revenue, but help you validate more your audience and build your audience more.
I think too, there are more efficient relationships you can build. So if you are connected to a VC, or you've targeted building relationships with a few that you know will make intros, or maybe you have a founder friend who's a really strong founder. I know this is a kind of a privileged point or action item, but I think that can be a lot more efficient than just, you know, kind of the spray and pray and trying to talk to a lot of people and wasting time there. So, question from Aaron from Angel Squad. How has your investment criteria changed over time? What did you think was important but no longer prioritize? And then what do you look for now that maybe you didn't initially?
This one's going to be really controversial, Haley. So I used to believe, like most investors, the founding team is all that matters. I no longer believe that. Obviously it matters, like who's running the ship does matter, but how much it matters, I think is what I've changed a lot over the years. I think, you know, if you have a spectrum of, oh, you need, like, if you were to weight team as like 0 to 100%, I would have weighted team as 100% or in the 90s or something. I think I now weight team probably closer to 70. Obviously the sweet spot is if you can have an amazing team and an amazing idea. But actually, I think, you know, after seeing a lot of companies now, I think actually amazing idea matters way more. There's a lot of luck. And here are my proof points. There are a number of companies that have strong product market pull that are run by people whom I would not consider to be the best founders, but they do extremely well. Why? Because customers just love it. And they can make a ton of missteps, and people just love it so much, they'll continue to stick with it. I think one example that comes to mind probably more recently is that there's been a lot of management changeover on everyone's favorite social media app, and it continues to run. You know, who knows how the new management will do, but I mean, that's an example of, you can have a fail hippo show up every 2 seconds in the beginning and people still stick with it, and it grows, and there's all kinds of changes in the CEO, and it still happens. And the other thing about it is companies that have strong market pull, they tend to attract a lot of investment naturally. Like investors just like are plowing their money in. And so then you also have more capital to work with and can afford to make those mistakes. The flip side is I've also had the privilege to work with many great founders, but their ideas were really hard to execute. And they can push that boulder up the mountain, but it's just so hard. And they can make it work. But it's like, gosh, for that level of talent, like you should really be working on something that is easier, where you're not forcing it. And you don't need those super salesy skills that you have.
Yeah. I have seen some founders who start with the idea or the solution and then try to back into a problem and customer. And I think that can be really hard. So that's something I've learned the hard way in some of my early angel investments. The other thing that I've noticed is you don't have to be good at go-to-market, but you have to have a desire to grind out on go-to-market across multiple channels. Where I've made missteps is focusing on founders who just aren't that interested in having to have a lot of conversations, doing things that don't scale on the sales side to figure out what could be scalable to hand it off to someone else. So those are a couple of things that I've noted and have changed in my evaluation framework. We have a question from Mayor. How does a founder get one-on-one coaching from a VC? Or maybe that question is really about building your personal network and influence, something nobody can give you a clear answer to. A better help for grinding founders. Nice. I love that. That's someone on this call. We'll start that service, Mayor. Maybe you.
I think the hard part now with the VC hat on is just time, because the VC's responsibilities is first and foremost to the portfolio. So certainly if you are in somebody's portfolio, then you should be getting good mentorship from your VCs or angels. And if you're not, you probably have very hands-off investors, and you may want to actually seek out other investors. I mean, not get rid of these people, but like obviously, add. So that's one thought. If you don't yet have investors, Yeah, it can be very challenging. And so I think building relationships is a process that takes time, unfortunately. So for those of you who have not yet quit your day jobs or are just kind of starting, I mean, I've seen a few ways. Like one, I've seen a number of people throw events or podcasts and invite investors on their show. And, that for a long time was a really good method. It could still be a good method, but like there are a lot more podcasts and events now that, of course, stroke somebody's ego, like, oh, I would really like to have you on our show, Haley. And then, you can get to know somebody through that because, everybody wants to be famous. So, so that's one angle, like inviting them to things that they would want to do that helps them. The other thing that you can do is, if you do have any friends who are angels or whatever, like try to network. In fact, actually, if you are in the means to even do a little bit of angel investing, so like, I don't know, write $1,000 checks here and there, almost by saying you're an angel makes it easier for you to mingle with other angels and VCs. And then from there, like I've had friends who are, I would call, quote, small time angel investors be able to raise more easily for their company because they're an angel. So that's another strategy that works. But I realize that not everyone is even necessarily in a position to write like a $1,000 check.
I think Mayor had also asked before this, what's the best way to find VCs that would be a great fit for your Web3 founder community that you're building, Mayor? Congrats. And I think that I've seen a lot of founders waste time maybe on like a NFX signal where it'll tag investors based on sector they've invested in previously without really showcasing that maybe they've done one ed tech deal out of 500 deals overall. So are they really an ed tech investor? So where you can be really targeted with the relationships you do build if you do invest time there. And just by searching, list of VCs in sector or sector VC funds, you will find a lot on both Google, Twitter to get you started.
Yeah, and I think Twitter actually is the last point, and who knows what's happening here on out. But I mean, I think it'll be around for a while. That's my prediction, hopefully. And so, I have built a lot of relationships with entrepreneurs on Twitter. It does take some time, but you can do that way. I don't know if you can get exactly one-on-one coaching or mentoring through Twitter, but at least if you're trying to get your name known in front of a bunch of investors, like most investors are on Twitter these days, just start interacting with their posts, post your opinions on things, etc. Like just start commenting and then, investors start to recognize your name and then see what you're up to.
Yeah. Another question from an Angel Squad member, Chris, thanks for this. When looking at startups that have been around, do you care about past dilution in terms of your decision-making or future ownership?
If it's really crazy, then yes. So for example, I think by really crazy, I mean, there are companies that come out of startup studios and, the founders only have like 10% or something. So for that, I don't love that, but often actually these founder studios are aware of that and are willing to do some sort of recap. I think as a small investor, like certainly as an angel, I don't ask for things like that. It's not worth it to do a recap, and nobody wants to do a recap for like my very small check. As a fund, even as a small fund writer, like I have tended to shy away from those, but at my old firm, we did regularly go in there and spend time like trying to fix it. And generally the startup studios were okay with it.
Oh, wow. And generally we see a lot of companies early enough that hopefully dilution is not that severe, right? I don't think I've come across any companies like that just yet.
Yeah.
Another question on angel investing from Kirsten. When is the right time to start angel investing? Even just one check a year. What are your thoughts?
I think it depends what your goals are. So there are kind of two camps of angels. One camp is angels, people who want to be super active, get better at investing, and potentially aspire to raise a fund someday. That's one camp of people. And the other camp of people is like, I have a bit of money now. I want to have an impact on other founders, kind of pay it forward type of thing, want to make some money. But angel investing is like not the thing I want to go all in on in the near future that I can imagine. Those are kind of the two camps. I think if you're in the first camp, like you need to have concerted sort of pool of money, and it doesn't have to be a lot. It could be like 5 to 10K a year. But then you also have to have time, because I think if you're going to do, like everything else, angel investing requires practice. So you have to see a lot before you can back into doing, call it 5 deals a year. Like ultimately angel investing or VC investing is a comparison game. Like every company looks great in isolation, but then now if you have 100 companies, who are the top 5 to 10 that you're going to pick? Like all of a sudden, not everyone is like in the top 5 to 10. So that's kind of, if you're in that camp, like you need to have the time to be looking at, call it at least 1,000 deals in a calendar year. That's kind of the level that you're talking about in terms of your time. And then money wise, I would have a pool of at least 5 to 10K of your own personal money that you're investing, so that you can write a 1K check in 5 to 10 companies that year. On the flip side, if you're doing it more passively, like a pay it forward type of thing, you may not get good at it because you're not seeing as much, but you are paying it forward. So be prepared to lose that money for sure. And so have enough means such that you're willing to lose that money, number one. Number two, for those of you who are entrepreneurs, it may be strategic because you can also say then that you're an angel investor. So even if you're losing a couple thousand a year or whatever, maybe it pays up because it makes your fundraising easier because you're able to mingle with other angels. So that's kind of the calculus I would have in these two camps.
I love the piece around just seeing a lot. I think Chris Kong, who asked a previous question, is an angel squad, said that he looked at like hundreds of deals before he wrote his first check. And I found that joining angel squad 10x'd my deal flow. So where I thought I was making really good bets, I was able to zoom out and see, oh, wow, a lot of these things aren't that differentiated or super competitive or whatever, just by being around other angels and seeing more things. And then also making smaller bets. I think my average ticket size went down 80%. So I was able to diversify things a bit just by being with a community of people.
One last thought, a cheaper option for people in this room, if you are in the serious camp, and again, it's more of a time thing, is you may want to volunteer to mentor at an accelerator. A lot of accelerators always want volunteers because nobody has time. And so if you had that time and you can mentor, that allows you to see a lot, right? Because every batch is pretty huge. And if you do a few batches, then all of a sudden you get a lot of reps. And you don't have to signal necessarily within the batch or within that org that you're an angel investor, you're just a mentor. But if you happen to see somebody great, like, oh, this one company out of the 50 in this batch is amazing, then you can just, write that small check. So that's another way to get lots of reps without breaking the bank.
Nice. Another question on angel investing from Jan. How would you think about how quickly to deploy money or make investments as a new angel? How do you balance this with the concept that it's a numbers game and so need to make enough, say 30 minimum?
Yeah, it's a great question. So you do need to make enough. I would say probably 50 minimum. At least when I think about my initial investments, they were not all that great. So you'll need a lot of reps, but it doesn't have to all be this year. It can be over the next, 10 years. So I think really that's why I say, okay, if you have a handful that you're doing each year, that gives you enough data points every year. And then you have time compounding on some of your earlier investments such that you can learn from those. So that's kind of how I would think about that. And then on the flip side, you do, to Haley's point, want to build up your deal flow such that you are making the best handful of investments that you can. So you should be seeing, at least 100 company, like you want to see 100 companies and kind of back into no more than a handful. And ideally, if you can see more than 100, then that would be even better. I mean, giving you some sense, I've done 700 deals, but I've also seen more than 40,000 companies. So that's kind of the level, the ratio that you're looking for. So a lot of it is a time of generating the deal flow and then proportionally kind of doing deals in that same sort of proportion.
Yeah. A question from Andrew, sort of on this note, as an angel investor with so many startups looking for funding, how do you address the fear of missing out of investing in the next unicorn? 40,000 potential investments whittled down to 700. How do you kind of make that jump?
I think you accept that you will miss. I think for us, the way we see things is if we saw it, we're excited because ultimately deal flow matters a lot. You have to see a lot to do some. So if you didn't see it, you never had that opportunity. It means you need to improve your deal flow. But ultimately you are going to miss, and that's just kind of life.
Yep. Question around TAM, and I love talking to you about TAM, Elizabeth, because you have somewhat controversial thoughts here. Do you prefer a pitch deck with a bottoms up or top down approach to TAM? And what's the key indicator you're looking at to identify that this is a big enough problem to solve? Or is it just based on your gut? And this is from Artemis.
In general, I don't care so much about TAM because I feel like so much changes about the opportunity in the market. And I generally believe you can find a big market that's adjacent. So an example is Airbnb. Like the market of number of people who want to sleep on the floor on an air mattress is small, but the hotel market is big, right? So it's adjacent enough. I think that the way as an entrepreneur, I like bottoms up because it's very easy to understand. Like if I were in the founder's shoes running this business, which I'm not, but if I were, how would I look at it? It's like, okay, I got to get this customer and then that customer and that customer. So like, if I get all these customers, how much money am I making? That's kind of how I think about things. I think top down is really hard because it ends up being very conflated. Like when people tell me, oh, the travel market is whatever, $100 billion. That's not your market. Your market's very specific. So it's easier for me to see like, okay, who is the specific customer I need to get over and over again? And do I think I can get enough of those? So that's my preference if I'm looking at TAM. But frankly, my TAM is more of a gut feeling of where do I think the green spaces are or greenfield spaces are more than anything, because you can't really prove that.
Yep. And then a question from Tal. Big vision versus actionable wedge in the industry. What's a more compelling pitch at pre-seed?
You have to have both, which is the unfortunate answer. You have to have both. You have to sell the dream for sure, but you also have to show, especially since there's nothing, that you have the ability to execute. So good data points that you can show that you can execute is, well, one, having done something on a short period of time. So it's like, I quit my job yesterday. I called up 10 customers today. They're all signing this week. Like, that's great, right? Like showing velocity of execution is something that people are looking for in addition to that big vision of where this could go.
Yeah. In looking at decks and in talking with the team this week, as we've reviewed a lot of teams decks who are preparing to raise in Q1, we have had this conversation a few times. One of the things I like to see is a beachhead market initially, just to show what you're going to do very tactically, and then answer the what happens if things go right question towards the end of the deck without getting too complicated. You introduce too many revenue streams, it can start to feel harder to execute, raise more questions and answer them. But yeah, I love the way you explain that. Thank you, Elizabeth. Here's a question from Joan. I saw angels starting VC because it's challenging for startups to get follow-on investments. What do you think about the angels' role in getting follow-on investments? I'm trying to clarify that question. Joan, are you asking about the ability to help in follow-on rounds, or if you want to clarify that, that would be great. And here's another question from Arshan. If you see a company with a solo founder, how much less likely are you to invest compared to a company with more founders?
Oh, I don't care about that at all. There are plenty of large companies out there that were started by one person. I think what is important though, is that you need enough of a complementary team to get you to that next level. So, you know, if it's depending on your idea, if it's like a very, I don't know, technically challenging problem and you don't have that background, who on your team does, if anybody? And if you don't have that, then that's not the right fit for your team, right? But that person doesn't have to be a founder per se.
And then you talked a little bit about not needing to see a lot of traction to invest, but what do you look for before a company has revenue? You talked a bit about idea, team.
Basically that. I mean, I think from having seen a lot, I have an idea in my mind of where I think at least the greenfield opportunities are, just simply because like when we look at all these deals, and Haley, you mentioned this as well, like when we see like 20 of the same idea, that is not greenfield, right? If we see an idea that, you know, maybe comes up once every 5 years, like, okay, maybe there's greenfield there. Then the question is more of like, why do we think people haven't gone after it. And if I can get over that, I would much prefer to take that bet over this is a sure market and there are 20 other players in it. Like to this point around CAC being too high, I want to go after the areas where I think nobody is working. And that model comes from the deal flow that we see.
Yep. Any mistakes that you see early stage founders commonly make?
Oh my gosh, so many. And I've made so many when I was a founder. Everything from spending too much time on fundraising, being too optimistic about investors saying they'll invest, deal's not done until money's in the bank, especially in this market, even signatures are not enough. I don't know. Spending too much time quibbling on equity, like doing things basically at the end of the day, your ideal scenario is, you have limited time. And so you should just be focusing on one thing. And if you only have time to focus on one thing, what is the most important thing at that time? For most startups, it's generally revenue. Not always, like if you're curing cancer, it's totally different, obviously, but like, if you are, let's say, a run-of-the-mill B2B software startup, that should probably be your goal. So do the least of everything else possible to just focus on that, and things like worrying about the legal docs and worrying about the fundraising and worrying about all this other stuff generally matters way less than just focusing on the thing that propels your business.
Yep. A question from an Angel Squad member. It can feel like pitches that come through any syndicate are really positive. We hear founders are amazing, the deal's amazing, amazing traction. How do we best learn to tune our radar and find out what maybe isn't an amazing startup? And would love to hear about ones that maybe aren't so great too. And this is great feedback as well. So we'll take this. Thank you.
Yeah, since we run syndicates as well, everything always sounds great. I mean, so a couple of thoughts. One, I think if you are participating in syndicates, and also I have done a lot of that myself, even though I see direct deal flow, there are often times where I would much prefer to do an SPV because, frankly speaking, it's less time. So there are definitely pros to doing syndicates, and but you have to take everything a bit with a grain of salt because you are not there doing the due diligence. So you can, number one, you can ask questions. Don't be afraid to ask the lead fund manager those questions, and that lead can then ask the founder. So when I generally see, oh, everything is up and to the right, like what are the natural questions that come to mind? Like, is it product revenue? Is it coming from their actual product, or are they doing something else? Is that revenue retained? Like if it's a SaaS company, like what are the retention numbers? That's really important. Are there upsell numbers that you can get? Like don't ever look at cumulative. It should be what is revenue happening this month, last month, the month before, et cetera. Is that generally going up, or is it splotchy? I mean, if it's not a SaaS company, it may be splotchy, but why is it splotchy? And it's less about the actual numbers, frankly speaking, and more about just trying to actually get a sense of, like, at the end of the day, why are customers buying this? Is this a real problem? And do people like the solution? Those are kind of the three questions you need to answer for yourself qualitatively as an investor. And sometimes I think people get too caught up in the revenue and use revenue as a crutch to try to answer those questions. But revenue does not always indicate that people love the product, right? If they're churning left and right, if they're a good salesperson, et cetera, like kind of forcing the sale. And it doesn't always indicate that there's a real problem, especially in the early days, because it may taper out. So you really want to understand more of the qualitative than the quantitative. And if you feel like you can't answer that from that information, like skip it.
I think too, what was helpful for me in joining syndicates initially was reading decks before reading the memo to try to form my own opinion before I got the sales sort of spin on a deal, and to answer the questions that Elizabeth mentioned. And then if there's an opportunity to attend a live pitch event, to ask pointed questions or just to listen to other angels asking questions. Because I think the syndicate leads are always going to present the deal in the best possible way. And also they're looking at a lot and trying to present the best deals in the first place. So yeah, definitely takes time to get through that.
One more thought on that. One thing I do in my investing is actually, because I've been an entrepreneur before, I often imagine myself like actually either in the business or as the customer. So when actually that's how I angel invest. So, or actually even invest out of Hustle Fund, like you see some deck or whatever, imagine yourself as the customer. One, do you really have this problem? Do you feel like you have this problem? I know that can be a little bit hard to imagine because, you know, you don't actually have that job, but just like try to imagine if you got that job, of all the other things that are going on in your life and at your job, does this seem like the top priority problem that you have based on your understanding? And if so, like, you know, what would you imagine as a solution? I think for most jobs, especially for any of the software companies out there, most jobs are not rocket science. So it is somewhat easy to imagine that in another life, you could have had that job. And that's kind of how I think about it. And if the answer qualitatively is, this doesn't seem like that would be the top of mind for me, I have like 20 other things I'm solving as head of HR or whatever, like, then that's not what I want to be backing. I want to be backing like, what is the top problem for this particular person? And are they willing to pay for it? And like, where's that money come from? And why are they paying for it?
And then flipping the mistakes question around on junior VCs, what are some mistakes that junior VCs make in selecting startups, and how can we fast track our learning?
I think I have kind of strong opinions on this one. So junior VCs, especially if you have not come from a founding background, it's a lot harder than to do this imagination exercise. I think as a founder, it's a lot easier because you have run a company before, you have seen all the problems in running your own company. I certainly have lots of scar tissue. So as a junior VC, here are the things I would recommend. Number one, you want to look at more than less. So if you're working on a traditional VC firm, you probably are not doing that many deals a year. Your firm is probably not doing that many deals a year. You should be actively going out there and looking at just a lot more. And if you're a Series A fund, you should be like, let's say going to seed or pre-seed, and maybe even as an angel, like take some of your salary and like start writing more checks and see a lot more, because the more reps you get, the better you'll be, even in your Series A job. So that's thought number one. Thought number two, if you have the opportunity to do so, like actually get your hands dirty and help out one of your portfolio companies, like find out what are the specific operational issues that people have. Actually, on our team, Will Bricker, like before we gave him an offer, I told him like, go and spend 6 months at one of our portfolio companies. And he did. And this was during the pandemic. And they were like flying to customers in the pandemic, trying to make a sale. Like it was hard. And this, you know, but it was like very informative of, oh my God, this is what it's like to be boots on the ground. So that way, when you're in your cushy chair writing checks, like you can remember like how hard that was, what are the hard parts, what are the things we can overcome, et cetera, and help you make better decisions in investing. Because ultimately, it really comes down to boots on the ground. It's not about financial projections, but like there are real people who do this job, and can they do it, and why, and what is actually happening.
Another question from Suraj. They liked your piece on preferring more startup investments, shots on goal, as opposed to doubling down to benefit from the power law. Could you share more about portfolio construction and what a large percentage position might look like?
Oh, this is a great question. That's like another hour. Portfolio construction is really, really important, because that is what will allow you to weather storms. Now, there's sort of a spray and pray model, and there's a concentrated model, loosely speaking. So spray and pray is you're doing lots of investments, call it, I don't know, 20 to 30 investments a year. Maybe your overall portfolio is 50 to 100 companies, maybe more. Concentrated is maybe you have like 20 to 30 positions in the whole fund across 3 years or so. So pros and cons, and there are winners in both. YC is in the spray and pray camp. Chris Sacca's fund, lowercase capitals in the concentrated camp. Both have done extremely well, like, you know, 200x multipliers or more. So that's incredibly rare, but can be done. So I think part of it is comfort. Like if you're going in, you know, if you're going in super new, I would recommend spray and pray to everybody, just so you can get a lot of reps, because I wouldn't assume that you're necessarily already great at investing. So you need to be able to afford a lot of mistakes. And the spray and pray model is much more forgiving of mistakes. I've certainly made a lot of mistakes, especially in my early days. If you then have a lot of reps under your belt, then maybe you might consider, well, actually, I'm pretty good at picking now, and so I want to move towards the concentrated model. In general, the way I think about things is if you're spray and pray, like for every 100 companies, hopefully you're capturing at least 100 Xers, if not more. Certainly if you get a 1000 Xer, then nothing else matters. So that's your ideal on a spray and pray. And in terms of dollar concentration on a spray and pray, it kind of really depends. There's a whole gamut. There's some people who just write equal checks in every company, and then you don't have to think about follow-on. You don't have to think about assessing whether the company deserves follow-on, et cetera. So there's just a lot more work if you decide to play the follow-on game, because you have to know who really is breaking out and who's not. So the easiest spray and pray is just equal checks on everything, and you can do fine. I mean, that is the YC model after all. And there are plenty of others in this camp. And then on the concentrated model side, like you have to really, because every bet matters, and you're putting in a lot of money on each one, right? Like if you have 20 positions in a fund, and let's say you have a 100 million fund, like you're putting in whatever, 5 million, 4 million, something like that into each company. You're doing a lot of due diligence, and you are trying to get a lot of dots to create a line, which means you're meeting with companies a lot. So in a market like 2021, a lot of people could not connect dots because there was not enough time. So that model can be harder to execute in a frothy market, but in a down market, you can take all the time you want, and that could actually work out quite well. But what you're looking for is this company really breaking out? Do you really feel like you know what's happening in the company across all those dots? Again, I would not recommend that model to new people. I would get your reps on a spray and pray model first. And then if you feel like you're good at that and you really want to concentrate, then concentrate.
What's your take on angel investors asking for or taking a board seat? And then how should founders address that ask? Flavia's asking.
So I think a few things to know about board seats. That's another thing that I think is a crutch, in that people think having a board seat will help them out with their investment, but at the end of the day, it really doesn't. So a couple thoughts. One, informal power without a board seat actually is very powerful. There have been plenty, we do not take board seats at Hustle Fund or in my own angel investing. There have been plenty of times where founders come to us because we're not on their board, and they tell us like all this stuff that they've never told their board member because we're not on their board. So you can actually learn more as a non-board member, because people are not, if things are not going well, they are afraid to tell their board members. Or like if they're considering an acquisition, you know about it first before your board members do. So that's one thing. You have information asymmetry as a non-board member, which is a real head fake. The second thing is, from an actual power perspective, I think the only time that matters is, well, there are two times when it matters. One, there's like some rogue or fraud situation in the company, and as a board member, you can save the company. So FTX comes to mind, and others come to mind. And the second situation is the company has product market fit, but the CEO is not the right one to lead it going forward. So you can potentially change out the CEO. But at pre-seed and seed, generally companies don't have product market fit. And I would say there's less fraud because there's less money in the business. So in general, I would say at pre-seed and seed, board members actually matter way less. And it ends up becoming more of a liability than anything, because you should have liability insurance if you're going to be a board member, which is expensive. That's also another reason we don't take board seats, because you could potentially be sued. So I would not recommend it to most angels unless you are coming in at later stages where there is product market fit. And, you know, for those two reasons, you feel like you are well suited to take care of those situations. There are many ways to have influence without having a board seat and even receive more information.
Let's take one more question. I love this from Rick. What's your take on business plans and projections at an early stage?
I don't care for them as an investor. We all know everything changes. Nothing goes according to plan ever. But I do think it's a useful exercise for founders to kind of project out, well, if this happens, if that happens. And that doesn't even necessarily mean spreadsheeting it out in detail, but just roughly speaking, like if I can get, 10 customers every week this year, or whatever at $30 a month, what does that look like? I think everyone should kind of go through that exercise and then kind of understand, at least for a VC backed business, they want you to get to kind of 100 million a year within 5 years. How do you actually do that? And it's really hard, but what are the levers in my business that help me get there?
Amazing. Thank you, Elizabeth. Thank you all so much for joining. Great to be with you. We got through a lot of the questions. I'll type answers, or we'll type answers to a few of the remaining ones, and look forward to doing this again soon. Thank you.
Thank you all. Take care.